Welcome to the Order Flow Trading Course, Lesson 14, Reading the Market with Order Flow. My name is Michael Valtos. I'm the founder of orderflows.com. First, let me go through a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, Lesson 14, Reading the Market with Order Flow. Earlier, I talked about how to read an order flow chart. Now I will discuss how to read the market with an order flow chart. Order flow chart is like an X-ray chart a doctor will look at to diagnose a patient and determine how to treat the patient. So, just imagine you go to the doctor, they take an X-ray. The doctor will look at the X-ray. He'll look inside your body to see, if there's anything he can see what's wrong with you. Just taking your pulse may not be enough. He wants to check your lungs and all that. So, an order flow chart sort of gives you that X-ray view into the market, as opposed to just looking at bars and trying to determine, were buyers or sellers, in control. Just because you see a bar closed higher than it opened, you're going to immediately think buyers were in control. But, sometimes it's not always the case. The truth about order flow is that the market is dynamic and in a constant state of fluctuation between buyers and sellers. Although order flow setups occur daily in the market, no two are exactly the same. It'd be much easier if every setup that occurred each time was textbook perfect, but we are often forced to deal with setups that push the borderline. What I mean is, they may look right, but they're not perfect. It's like you're never going to get two exact setups looking exactly the same. Numbers are going to be different. Volumes involved are going to be different. So if you're a serious order flow trader, you'll want to know when and where order flow works best. The information generated by the market is always giving the trader clues as to who is in control of the market. Once a trader becomes adept at reading the order flow as it happens, then the trader will be able to anticipate price movements. So, you have to learn the basics of order flow. Then once you have the basics down, you start to put it together. And, then you become a more complete trader. Sometimes you really, when you're a kid, right, you want to investigate everything. The markets are the same way. You sort of want to investigate what's going on and, understand it. Like when you're a kid, you see grass for the first time. You want to understand why it grows, how it grows. You're not necessarily going to build your life around it, but, once you understand how the basics things work, then you understand, the broader things. So, let's just jump into it. Consider a market that's selling off. In order for the trend to reverse from going down to going up, conditions have to change. So, in a downtrending market, sellers are in control generally. I say generally. Obviously, if the market's going down, sellers are pushing it down. There's going to be times when that's not necessarily the case. There just could be no support in the market. Not enough bidders, and the market is just drifting lower. I hate to use the term drifting lower, but there's not enough support. There are always buyers and sellers in the market, and sometimes there's just not enough buyers to support the market. So for a market to turn, buyers have to take control by coming into the market with sufficient quantities to overwhelm the sellers. For example, here's a 10-year chart. We're going down, making new lows. This red line here is the lows. You hit the bottom. Right here, you have a divergence, you have a ratio. I talk about the ratios, the small prints, the single prints, and you're seeing a shift in the market, in the control of the market. Earlier sellers were in control. Now all of a sudden you see buyers take control. So alternatively, in a market selling off, the market can turn when the last seller has sold. It's not always a case, clear-cut case where buyers and are taking control. When there's no more sellers, to move the market lower, the market will just naturally rise. Imagine there's sellers coming in, selling. At some point, the sellers just have no more interest to sell. When the last seller has sold, that's going to be your bottom. So, when there's no more selling interest by traders, who's left to sell? Nobody. Prices have, basically no other way to go except the up. However, if there's not strong buying coming in, buyers don't take control. The market can trade sideways until either side takes control again. There's always going to be buyers. There's always going to be sellers. One side is going to be the dominant over the other. But, if a market is trending lower, there's going to be active selling. But, once all the sellers have pretty much exhausted themselves, the buyers are there still. And people need to buy. But there's nobody selling it at these low prices. It's just going to start going up as buyers are competing with each other to get in to buy the market. So, consider a market that's rallying. In order for the trend to reverse from going up to going down, conditions have to change. In an uptrending market, buyers are in control generally. Again, I say generally. There's times where, you're in an uptrend and the market is very weak at the high uptrend, and, buyers are starting to weaken and sellers are starting to take control. The market may not just necessarily be going down. You could be forming a weak high in the sense that, there's just buying is getting less and less until there's no more buyers. So for a market to turn, sellers have to take control by coming into the market with sufficient supply to overwhelm the buyers. So again, alternatively, when a market is rallying and buying volume has been steadily decreasing, is a sign that bulls have bought all the supply they need. When there's no more buying to support the market, what do you think will happen? Well, if there's no more buying, if there's no more support in the market, what's going to happen? The market's going to drop. The market will start to move lower or sideways until one side shows their strength in the market again. So, just think of it. Everybody's rushing to buy as you're making new highs. Everyone thinks this is it. The market's going to go to the moon. But then, once people realize, hey, maybe the market's not going to the moon, either they stop buying for, they just don't think it's going up anymore, or, they've bought enough and they've got no more spare cash to buy anymore. Well, if they're not there to support the market, what's going to happen? The market's going to drop. This is a 10-year chart. We went from the low, we started moving higher, and, we get up to this point here where, you got a single print, one lot. Where's the rest of the follow through? Where's the rest of the buying? It's not there anymore, and the market just sells right off. This is a case where literally the last buyer bought, and, there's just no more follow through, and the market sold off. So, questions you should always be thinking about when looking at an order flow chart. Are we in a range? Are we currently in a trading range? Where are we in relation to the day's highs and lows? Is more trading happening on the bid or the offer? Is the market moving on aggressive buying, or is it moving on aggressive selling? What's happening in the market? Keep, thinking about what's happening in the market. People that follow indicators, they don't care what's going on in the market. They just say, I'm just sitting here waiting for this line to change from red to blue that I'm going to buy. Or I'm waiting for my blue arrow to kick in so I know how to buy. That's not trading. Other questions you should be asking, is price being rejected at current levels? Or, are the price levels with heavy volume? Are we getting to an area where the market is facilitating trade and we're putting in a lot of volume without moving? Is the volume heavy or light for the day? Is volume heavy or light for the bar? Is the delta positive or negative? Are we trading above or below the POC in the current bar? Or are we in relation to the POC in the previous bar? Well, it does seem like a lot to process. It really becomes second nature. Don't let it scare you. I said, you look at an order flows chart and you see a lot of numbers, and you tend to panic. But, just remember when you're younger, when you're learning how to drive a car, there was a lot to learn, but you mastered it. You're still alive, You haven't, you may have gotten a small fender bender, but, for the most part, you can drive well. And, some of it comes with experience, just putting in the hours driving. But, as you're driving, you don't think back on all the little things you learned and when you're driving and apply it. You apply it as second nature. You don't sit there and constantly refer back to your training manual, or your book that you got when you, learned to drive. I learned to drive in the state of Illinois, and the book was called The Rules of the Road. It's not like I kept that in the car, and when a car would swerve in front of me, quickly refer to the book. What to do when a car swerves in front of you. It becomes second nature to you. And, order flow is the same way. It will become second nature to you. Order flow comes down to common sense. It allows you to gauge the current state of supply and demand. Like I said, once things become second nature to you, things are really clear, and in a basic sense, it's common sense. So you're going to determine whether the market is being rejected by traders, whether the market is being accumulated or distributed, whether the market is being stopped with big buy volume by passive buyers, or big volume by passive sellers. If you get to a level and you see heavy volume on one side or the other, it's telling you there's passive buyers or passive sellers. All those things, once you see it enough, you can just tell at a glance. You don't need to sit there and analyze every single number. The facts are in front of you. Expert order flow traders anticipate what is coming based on their analysis of what is happening now. I should say now, not. My analysis is this, so I will do that. That's what you're always thinking. You say, okay, I see. It's where you are now. You're sort of basing it on just what happened preceding, and you're trying to anticipate what's going to happen. Like, Wayne Gretzky, probably one of the greatest hockey players of all time. And, he had this quote, "I skate to where the puck is going to be, not to where it's been." He anticipates where the puck is going to be. He's not stuck at where it just was. And, trading the markets are the same way. You're trying to anticipate where the next few ticks are going to be in the market. If it's going to move up or going to move down. That's when you want to get into the move. You don't want to get into the move after it's already happened. You're reading the order flow to see what's happening in the market as it's happening, to position yourself to take advantage of the move. Not wait to see the move happen and then get in. I often get asked if there are a set of rules I refer to when trading order flow. I reply by asking, when you drive, do you keep referring to a set of rules? Like I had mentioned earlier, you learn how to drive, and after a while it becomes second nature. You don't refer to rules when you're in a traffic jam or you're at a red light. It becomes your instinct. Trading should be like that. You make your best decisions based on your training and experience. That's what you do as an order flow trader. Unfortunately, it does take experience. I don't think it's going to take you 10,000 hours like some people say. My gosh, 10,000 hours is 5 years of your life. You say you're looking at the market 8 hours a day for 250 days. It's going to, how many years? I mean, you don't have years. Nobody wants to spend years, learning how to trade the markets. I mean, the best traders, they absorb what's going on in the market. They're able to put 2 and 2 together. They don't need to see something. If you have to look at a chart and see the same thing happen over and over 10,000 times before you get it, there's something wrong with you. I remember when I was on the floor, everyone back in the days of the trading floor at the CME, pretty much everyone started out as a runner. The natural progression is runner to phone clerk to, ARB clerk in the pits, to filling paper, or, a member filling orders for your member house, or trading for yourself as a local in the pit. But, really, if you're if you start out there and you're a runner for more than 3 months, as bad as it sounds, people will start to think you're retarded. I mean, no offense to retarded people with mental disabilities, but a runner is a very basic job. If you can't pick up what's happening in the markets within 3 months, your career is severely stunted. In general, that's the way that people took it. I mean, if you read the book Market Wizard, you read the section on Tom Baldwin. It's a pretty short section, but he basically puts it well. He said he stood in the pit and he watched what was going on, and after a few months, he got it. If honestly, 10,000 hours, if you don't get it, after a certain amount of time, 1,000 hours or 2,000 hours, then you're probably not going to get it. As a parent, you want your kids to all play instruments, and I learned piano lessons. I took piano lessons as a child. Yeah, I could play the piano. I'm not good at it, but I was able to play the piano. I'm never going to be a master musician, pianist, but I could play the piano. It's like trading. If you train yourself, you should be able to do it. I'm not saying everyone's going to be take this course and all of a sudden be the best trader in the world. No, I mean the elite traders are a rare air, but to be a consistent winner, it's possible. Just as you could train your dog to do certain tricks, you could train yourself to do tricks. Only instead of tricks, you're teaching yourself how to trade. So, getting back to order flow analysis, it's the only known method of trading that enables you to get in at the beginning of the move, keeps you posted throughout the move, and gets you out when it is culminated. And people that trade with indicators think they've got the holy grail. It's not, obviously. If it was so easy, the big banks, Goldman Sachs and etc., they would all just be running MACD or RSI indicators all day long and be banking massive profits more than they already are. But the fact of the matter is, it's most indicators don't work. The majority of professional traders out there, they're able to read what's going on in the market and synthesize it. They're not just synthesizing, the market looks overbought because RSI is above this level, or hey, we crossed the zero line, it's time to sell. I spent a good 20 years on the institutional level, and I've never seen okay, I take that back. I've seen one institutional trader that even mentioned the word MACD or RSI, but other than that, these guys who walk around a trading floor at a bank, they're not looking at these charts full of indicators. They're not. So to think that someone could come into the market with a small amount of money, turn it into a big amount of money using indicators is a stretch of the imagination. So, that said, let's jump into examples and learn how to read the market with order flow. Okay, what I'll show is a before chart and an after chart. I'll just sort of talk through what's happening. So here's an E-mini chart. There'll be a different contracts, different ranges, and just sort of give you an idea that these same theories apply for different times and different types of charts or different commodities. So what do you have going on here? Your market's starting to rally up. Okay, you've got a ratio here. You've got a ratio here. The blue numbers, a single print here, a ratio bounds low, indicating some stopping volume. Then the market is just it's going up, but you have a negative delta here. Here you have a negative delta. It's sort of sandwiched in between these two with positive deltas. Then you get up here at the high, and you got a big negative delta. What's that telling you? Okay, where's the follow through? When you're coming up, and it looks like price is being rejected down here with with the ratios, but the delta is slowing down. You do get a final pop up here, then you hit the high and you get a big negative delta. Why isn't the market following through? That's the question you should be asking. As the market is rallying and you're getting bullish signals here, but then it just goes flat on you, goes sideways. So be careful. I said you get up near the high and you hit the high, of a move. It doesn't necessarily have to be the high of the day. It can be the high of a move. And you get a negative delta coming in, a strong one. Okay. If you're long, you might want to consider getting out. If you're not in a position, you might want to think about getting short, depending on what happens, shortly thereafter. But, if you're long, be wary. The move higher may not be continuing. You're seeing a slowing down of the buying with a smaller delta. Then you see more selling come in with the big negative delta. Okay, so what happened? Okay, this is where we are with the big negative delta. The market couldn't continue up, and it just sold right off. Basically 7 or 8 points. But it was telling you earlier, as the delta was slowing down and shifted to negative, you see the next bar came right up to the point of control, acting as resistance, and then sold off. Okay, so this next chart is, again, it's the E-minis, and what do you see? The market came down, hit this low. Okay, you got a positive delta here, positive delta here, positive delta here, but what's happened is it's gone sideways. You've got 3 bars with positive delta around the same level. What's interesting is, okay, here you have this single print, but you know what? We came back up through it. Here you have 2 buying imbalances, at the high end of the bar. The delta is still fairly negative, but there was some buying earlier causing you to have these buying imbalances. So keep that in the back of your head. Looking at the point of controls, we're sort of lined up, going sideways. The point of control on this bar is a little negative. Usually when I see buying imbalances at the top of a red bar, it's telling me that there was buying early, but something changed inside the bar, and the market traded lower. Just as you see, you have this buying imbalance here, 847, and the market traded lower. So, if anything, I'm more inclined to be looking to get short here, even though, you've got 3 positive deltas, but, the deltas are getting smaller, 700, 600, 100. The point of controls are all basically around the same level. If we're going to stay below this, these point of controls here between, 87 and 86 3/4, on the back of, a couple buying imbalances here at the top where the psychology of the bar change, I'm going to be looking to get short. And what happened? We stayed below this point of control. We sort of go sideways to lower. And you're seeing the negative deltas getting stronger, minus 2,000. Here, 391 is kind of slightly above neutral. 1,300, but the bar is red. You got a positive delta. You expect the bar to be green, not red. There's no follow through. Then you get this doji candlestick where there's no ratio. For me, I tend to view doji candlesticks as kind of neutral in terms of order flow. That's why I don't publish a number above or below. Then you see that the delta is building up again, minus 600, and in this bar it's minus 1,800, and the market's going lower. Okay, so this is a 10-year chart, and just looking at what's happening, 10 years it's a market that can move very slowly. It's because there's a lot of volume involved, and when there's a lot of volume, sometimes it takes really a lot to move the market. But what's happened here is we're going up towards the high. We get within a tick of the high. The high is here at 128.19.5. We get up to 19. Come off a little bit, circle back around it, got a single print, a tick off the high. Then, with the negative delta, the first time you got a negative delta, it's a small one. But then here you get a positive delta, 1,800. Okay, I'm kind of mixed. I'm not necessarily sure the market's going to sell off yet or continue up. I mean, you got the positive delta. You're more inclined to think it's going to go higher. And then what happens? You get this single print here. There's one lot, and people couldn't take it back up to the high. And then you have this single print here. As we're a little bit lower, again, the market's trying to come back up to the high, and it can't. There's just no more buying interest. The delta is fairly small, 266. So if you really weren't short in this bar based on what you're seeing here and here, getting short somewhere in this next bar, there's a lot of opportunity to get short. So what happened? I mean, the market, it did come off a little bit. It wasn't, the greatest trade in the world. It did mostly go sideways, but, there's an opportunity to get, a couple of ticks out of it. Okay, this is a 10-year chart. Again, it's a chart that, 10 years trade a lot of volume. This is, gives you an idea of the type of volume. This is 2 in the morning Chicago time. So this is around the European Open. And what happens? We're stair stepping our way up, new highs, over, 2.5 hour period. And what happens? You get up to the high, you get a small delta. Before on the way up, you're getting strong positive delta, 4,000, 2,000, 5,000, 4,000. You get up right at the high, you got a red candlestick, you got a positive delta of only 163, and you got a single print up here. You got a ratio that you like, indicating that the buying has dried up in here. We're at the high. If we're going to go higher, why don't we have still strong deltas that you had earlier? At least a couple thousand. 163 is nothing on a market that's trading 10,000. Pretty much in each bar. So what happened? You see, selling came in the next bar. This is the high that we made. It's got a very small delta. So if you're not necessarily convinced that this is the high, watching what happens in the next bar, boom, you get a big, strong negative delta. Whereas before on the way up, you're seeing, 3, 4, 5,000. Now on the way down, you should be seeing 3, 4, 5,000 in the selling side, and you're seeing that. So if you're not short based on what you see here, definitely in this bar, what you're seeing here, you should be getting short. And so it went from 31 down to, well, this chart goes down to 26. But again, you're making your move down, and you're seeing the deltas being strongly negative. 3,000, 3,000, 5,000, 5,000. Okay, so this is the 10-year. We're working our way down quite nicely. We're getting ratios here, ratio here. You hit the low, you got a divergence, positive delta. Test it again, you got a positive delta. Nothing in there is indicating, these are just kind of average ratio numbers, 17, 20. That's why they're black. If they were blue, it would be a ratio that I like. But what you're seeing, some strong buying come in. Even though we hit the low, boom, there's buying coming in right after. You're seeing buying imbalances, buying imbalance. 4,000, 3,900 is basically 4,000. And, is there any more selling coming in? Yeah, it should be showing up. If it was still selling, you'd have, smaller deltas. But you're seeing, basically big, tectonic shifts almost in the delta, where it's minus 2,000, 3,000, and you get 4,500. Here it's minus 1,800, but then it's met with very strong buying, 4,000. You got, you're seeing strong buying when it comes in. It's fairly strong. Earlier you had 8,000 of buying imbalance. If these buyers, here you got 8,000, 8,000, 4,000, 1,800, 3,000. If these buyers can just get a little wind in their sails, so to speak, hopefully the market can start to rally. These big buying imbalances, I'm skeptical of them just because we're still on our way down. We got bars with negative deltas. So they're still selling in there. Like you can still see, even though you have a big positive delta just above it, you've got, a big buying imbalance just above it. You got a big selling imbalance of 7,000. Kind of negates itself out. You got 12,000 that were sold into here. But like I said, you're starting to see some signs of life. You're seeing overall net buying in the bars. And what happened? The market did squirt up a bit. It wasn't like the greatest move in the world where it moved, 2 basis points or anything. But, it was a nice move up. This was the last bar there where you have this buying imbalance, 3,136. You see it here, it went bid. Again, you're seeing buying imbalances right around that same level. And then the markets, just, it gives you an opportunity to get, get a nice little winner there. Okay, this is a E-mini chart, and here you have a divergence. So this is the high, and what happens? We've hit a high earlier, but it's got a delta of 2. Okay, which is incredibly small. I mean, small would be 0, I guess, but there's not much difference between 2 and 0. And what happens is you see some selling come in. Negative delta. Here you got a ratio, but then it sort of slows down again. Buying takes over. We pop up again to this high level, but then the selling comes in. Now what you're seeing is a little bit different here. Is immediately after it, you've got a selling imbalance, and even in this bar, you see the aggressive selling, 376, 1068. Then in the bar following it, you've got you got a single print here. You've got a selling imbalance. Earlier here, you didn't necessarily have much, and it's just said things were evenly distributed as far as buying and selling, right? You got a delta of 2. In the next bar, even though it's got a strong negative delta, it was met with some support down here. Whereas here, you got the selling imbalances where it's really stronger selling, it's more aggressive selling. So, even though you have a strong negative delta, yeah, I do like getting short off of this, but, in here it's a little bit, makes the argument much clearer, I think. Here we just sort of went sideways. So, I said I'm more inclined to be getting short off of this setup here where you have a divergence and immediately following it, you've got a ratio. I do like that you have the selling imbalances in there. You don't necessarily have it the first time. And what happens? The market goes sideways. I'd expect the market to go lower faster, but the fact is, it's not going to, doesn't appear to want to take out this high here at 1894. And I'm always looking to get short somewhere around this zone, maybe a little bit past it. That's being optimistic, but you have a single print here. I'm always looking for the market to trade back to a single print before selling off, and it did. It got within a tick up here at 92 3/4. And before trading below 1890. Okay, again, here's a mini chart, and what's happening? We're going sideways to a little bit of a pop-up. We got a big buying imbalance here. 2,000. That's a pretty nice sized chunk there, but then what happens? We get up here to 1900 almost, 1899.75. And you've got a ratio, a ratio bounds low, indicating some heavy stopping volume up here. It's slightly higher than this high that we hit earlier at 99 and a half. It's a tick through it. It's on the back of this buying imbalance, and you're thinking, okay, if you're not looking at this bar here at 1230, at 1224, you're thinking, hey, this could be the start. We could be really looking to move out of it, but then it comes right up here and stops with this heavy volume right at the top of the bar. After this period where we're sort of going sideways, you're thinking, hey, this area in here at 96 and a half, is probably going to be my support where you got these point of controls sort of lined up. This other one here just after it, you get a single print here, you've got a strong buying imbalance, but you hit this area here, this bar at 1230, where the market just stops and drops, and it drops right down through this area of this buying imbalance. And you should be asking yourself, if you're long in here, you better be very careful, on holding that long. Like I said, there was a couple signs in here that, hey, maybe we could start to move up, but then as soon as you hit this wall up here, so to speak, this 1228, and we can't really get past it, and the market turns around, and the bar ends up negative. So what happens? The market just sells immediately off of it. It's the stopping volume up here. This ratio bounds low. That's why I have these numbers drawn, not drawn, printed. And, if it's a ratio that I like, it's going to be blue. If it's just an average number, it'll be black. Then what happens? You can see, the market sold off quite nicely. You see the selling come in. So, if you weren't necessarily convinced that this was the end here, when you see this next bar with a strong negative delta, you should be getting short, especially if you're long. Get out. If you don't necessarily need to get short right away, but, get out, reassess it. I think it's a good sell based on this ratio here and the heavy volume here. You get short at 94, you take it down 4 or 5 points. Now, I'm not talking 4 or 5 ticks. I'm talking, from 94, 95 down to 90, 91. Within, 30 minutes. That's a nice trade. It never went back up here, never went against you. Okay, so this is a E-mini chart again. It's a 10 range. I like a 10 range chart. It's finding a type of chart that you like to trade is a bit like Goldilocks, going in the bear's house trying to find, a bed that's comfortable to sleep in. Sometimes, a 10 range chart is just nice. There's going to be times when the market's slow and a 10 range chart is very difficult to trade. But in general, I like a 10 range chart. I use 10 range. I use 5 range as well. It depends on the speed of the market. So, this is a 10 range chart. And what do you have here? The market had come up to this high, sort of stopped up here, going sideways. You got a negative delta. You're thinking, okay, well, maybe this high isn't going to hold, and the market will start to sell off. You got the negative delta, and then it stops here and turns around. You got a negative delta, strong one, then you got a negative delta, fairly strong, positive in the other direction. You have a ratio. Then what you have in this bar here at 11, you got a couple of things. One, you have this buying imbalance, stacked buying imbalance at the top of the bar, and at the bottom you have a selling imbalance. And it's giving you a ratio telling you there's a lot of, there's heavy volume down here. Take it into context with what just happened. You got a ratio, a small print here, and again you got a ratio bounds low, which is also indicating, some heavy volume down here. So, if you saw this high and you notice the market sort of reacted off it, now you're starting to see it rev up again, with the aggressive buying. There's some strong selling down here that is, even though it's strong selling, it's an imbalance. The market turned, and, it's a selling imbalance on the low. People talk about traders being trapped. To me, these guys they're sort of stuck. And, people were trying to sell the market to make it go lower, but they couldn't. There was a strong bid there, and the market popped up. So if anything, I'm more inclined to be looking to get long than get short. Earlier I thought maybe it'd be, with this high, it's kind of weak with the delta, then the strong selling came in. Then I see this next bar, you have a small print here, a fairly strong delta of 1500. But then you're seeing these imbalanced structures in this bar. It's time to get long. And what happens? The market squirts up. It wasn't like the biggest move, but what you saw is, the market came back into this area of the buying imbalance, and it held as a support level. The market rallied about 4 points more or less. It was a decent move, but then when you get up here, what do you have? You have a buying imbalance right at the top. You have a divergence. You got a negative delta. There's a couple of things happening here. So, had you been long and you see this happening here, you should be looking to get out somewhere in this bar, to a lesser extent in this bar. So, I'm not saying you would have bought it right here at 5 3/4 and gotten out exactly at 10. It's the way some people talk about trading. You see their charts, say, oh, you buy exactly here, you sell exactly here. It's not. Trading is not a perfect science sometimes. So you're getting long somewhere in here, ideally, somewhere in this zone, and you're taking it up here. You're seeing this heavy stopping volume up here, this buying imbalance, and then the market can't get through it. It's really, when you're trading up here, you're not sure yet that this is going to be the high. But then when you start coming off down here, the propensity for the move to come back up again and take out that high is sort of diminished. So if you're not getting out in here, you should be looking to get out somewhere around the 08, 07 level. 06 is really cutting it. But, based on what you're seeing in this bar, you should be getting out here. That said, if you didn't get long in here, I'm not a person that likes to trade in and out, back and forth all day. I'm more of a, I hate to say intellectual, but cerebral trader is probably more of a better thing. I'd like to do a trade, then, close it, take a step back and reanalyze it. I'm not the type that will always just be looking for action and saying, oh, I got to get long based on this. Ooh, then immediately, I'm in a position, okay, I'm going to get out and get short, sort of reverse the position. There are traders that are able to do that. I said, me, I'd like to analyze things a little bit more. It's probably, I don't say it's a drawback, but, it's something that I do. So, had I not been in this position and I see this, I would have been looking to get short, based off this divergence, off this buying imbalance up at the high. And, even in this bar, even though it's not a ratio that I like, I do like that you got the big negative delta finally. Earlier you had the divergence with the negative delta, but you didn't necessarily have a reason to be getting short other than the divergence. Now you're starting to see the negative deltas build up here. Minus 600, minus 1800, minus 2000. Really, if you're looking to get short in this bar, it's already pretty late. I said you have this setup here with the buying imbalance. You should be looking to be getting short somewhere around the 7.5, 8, rather than at 5 or 4.5. You're giving up most of the trade. You're giving up quite a bit of profit potential. So you should be able to after a while you'll start to analyze the charts, and you'll pick up things as they're happening, and your entries should get better rather than I'll say getting worse, but being slower on your entries. So what happened? Like I said, if you're getting in down here, it's a little bit late. Really the ideal place is to be getting short somewhere in this bar, at the 07, 07.5, 08 level. And where'd it go? It went down to, below 1901. Even if you're getting in this bar, which is a bit late, it does have a little bit of a capacity to move. But I think, if you're getting in here, I think it's a little bit later. It's a poor, and it's an okay entry, but I think it's just a little bit poorer. I think you're leaving a little bit of money on the table. Okay, again, this is an E-mini chart, and just reading what's happening here. You come up to this high right here. You still got a positive delta, so it's slightly less than the delta before, but you may not necessarily be convinced yet that this is going to be, the end of the move, that the move is going to be over. So you're waiting for the next bar to see what develops, and you got a ratio here, a single print, okay, and a negative delta. That's the first sign. Then you have a ratio here, sort of some heavy volume, stopping volume. You should really be looking already in here to want to be getting short. Here you have a single print. And so you got 3 in a row. Now you got 4 in a row with this other single print. I mean, what more do you need from the market to tell you, hit you in the head, say, hey, sell me, so, get short. You got, this 3 in a row, then you come back and you rally right up towards, this single print here. It's above this point of control. You should be looking to get short somewhere in here around this 69 level. At worst, somewhere around the 69 level, but, off the back of these two, you should be fairly confident in getting short somewhere in this bar, especially as the delta has picked up. But, sometimes it's not easy to see that sometimes, and sometimes people wait for confirmation, and, in the end, waiting for confirmation sometimes will, trip you up, and, you'll miss trades. But, I said, there's nothing wrong with waiting for confirmation. It does affect your bottom line because sometimes you'll miss trades just waiting for that confirmation that never comes. But that said, if you're getting short, even in this bar here, say call it 68, 68.5, and what's happened. Watch what happens in the next chart. We do sort of go sideways, but sideways to lower. So even I think really you should have been getting short somewhere, above 69. But if you're getting short at 68.5, 68, it does give you, it moves lower. It's not like the big move that I like to see very fast. It's going sideways to lower. Usually when it goes sideways to lower, it's just telling me the market is sort of lost its steam. Earlier, starting the move is pretty dramatic. Then, you get in here, and then you start to go sideways. That's why I say you should be able to read it. Hopefully you can pick it up a little sooner, and you're looking to get short around the 70.5 level as opposed to the 68 level. I said if you're short at 70.5, you could have easily gotten 5 points out of it, more or less. But getting short at 68.5, once you start going sideways here, you're only getting maybe a point, 2 points out of it, a point and a half out of it. But, it's something that will happen, with your trading. Over time, you'll get better and better at it. You don't expect everyone to just sort of come in and start, putting up winners left and right. It takes some time to understand it. And that's why this course was developed, to sort of help you, go through a lot of the setups, teach you how to read the order flow. Okay, so what do you have here? This is the E-minis. We're sort of going sideways, and we start putting in a rally, going up and up and up. Positive deltas building up, 123, 459, 445. You get up to this swing high. You have a ratio here, 38, indicating a small print. And what happens? You get a sell-in imbalance right at the bottom of the bar. Now, me, the way I am as a trader, I'm more wired. I'm more inclined to want to get short somewhere near a high, a swing high, a high of day, as opposed to get short at the low. I find the market's got more capacity to move lower when we're trading higher, as opposed to move lower and keep moving lower all day long. I mean, don't get me wrong, there are days when, it's just a one-way street, and, trying to pick an area to buy, I'm going to get, take a few punches. If you just think, well, if you just sold, the day the market closes down 3%, thinking, oh, if I just sold instead of being an idiot and trying to buy, well, those days where you're down 3-4% are more rare than days you're trading in ranges. I'm not going to say I'm a contra trader or anything like that, but, I'm looking for areas where I think, the market's going to turn based on supply and demand. I mean, there are arguments to be made that when you're trading at a low, supply is, overwhelming the buyers, and it could be that way all day long. That's up to you, whether you want to sell near lows or near highs. For me, I prefer to sell it after market has rallied and I see an imbalance. So what happens? You got your imbalance here. Again, you have the ratio, right? You saw here 38. Okay, it's telling you, buying has dried up at the top of that bar. So what happened? The next bar is you get another ratio. You get a single print of 3. The market did trace back through the selling imbalance. Okay, that's fair enough. Sometimes, the market is going to overshoot it. Like I said, you're trading, you have your imbalance here at 81 3/4. And all of a sudden, next thing you know, you're trading 80. It's going to snap back, and sometimes it snaps back, through that area. Now for the next 2 bars, we sort of go sideways. We make another run up at this single print, which you often do. I often talk about single prints as being support or resistance. And, first time you have the single print, second time you got a larger number, 500 lots traded there. And then the market sold off. The fact that we couldn't get above the single print to me is, usually a sign that, that there's, here you can say there's more buying, but couldn't get through it. Usually though I see a single print or small prints as support or resistance. I mean, if we got past this single print, the next level I'd be looking at is this point of control here, and then this small print up on top. But the fact is, we didn't get past this single print. We came up to it and then sold off. Okay, this is a Euro stock chart. Euro stocks is the European stock index traded in Eurex. And, what's happened? We've hit a low, and we've reacted off it. What happened? We come up here to, the 30.01 level, and you get the point of control right at the top. You got a ratio bounds low here, indicating there's heavy volume. You can see the point of control is right on the top, so it's going to obviously tell you that that's where the heavy volume was in the bar. We came back up to it, 2 bars later. It's still got negative deltas for both of these bars. It's looking very toppy, especially once you get up to this same price level, but there's no more follow through, and you do it on less volume. So, if anything, I'm more inclined to be looking to get short, not thinking that this move from the low is going to be continuing. And what happens? The market sells off nicely, keeps making new lows. The deltas are still, negative and sort of building on it. You got minus 580 here, minus 1,000, minus 600. Here 192 is nothing. It's fairly small. I'll say it's nothing. It's fairly small, but again, you have a ratio, which is still, it's a single print, sort of telling you that you want to be looking to get short. You see this ratio down here at, this 540 lots, so it's a ratio bounds low, but, I've already decided that we're sort of in our downtrend, based on what I've seen here. If I'm not short in this bar the second time we hit it, I'm short either in this bar at 836 or 838. The fact that I've got a couple single prints here to, hide behind as far as, if the market's going to trade up through it, I'll be looking to get out. If anything, I'm more curious to see what's going to happen when it comes down to this level. It came down to this level here at 29.91, and there was still more volume there. It traded 1900. So, what I want to see is if we get past this volume, and we did, and then we sold off, again, quite dramatically. So, this was a nice move, at least 10 ticks out of it you could have gotten. Okay, the Euro stock again, this is sort of a continuation of that move from earlier. We were just here working our way down. Then, what happens is we get down here at the low. Now you have a divergence, and you got a big, strong positive delta, 1100. You have a single print here of 8 lots. It's giving you a ratio of 32. Right now it's indicating, hey, get ready. It's going to be all systems go. Here I wasn't necessarily concerned about this ratio because you still had the negative delta. Oftentimes when I have a ratio, but the delta doesn't go in the same direction, if it's a buying signal, but the delta is going opposite, I'll often supersede it with the delta. I'll look for the delta to reaffirm itself, show its strength a little bit later. It may not show it immediately, but if we're going to come back down, I'm going to look for that delta to reaffirm itself and continue in that direction. But, so it came down to the low, negative delta, slightly, strong negative delta, only the low minus 2100. But then the next bar, there's negative delta, but it's still kind of a little bit lesser than what you had the bar before, 2100. Now it's only 973. Then you see the shift in supply and demand. Now you're seeing demand pick up. You got a couple of imbalances here, which sort of go contrary to these selling imbalances. But what you're seeing is a big shift in the delta. You're seeing demand start to take over. So, if you're not yet convinced here, okay, let's wait to see the next bar, but, even getting along, off of this, your stop is just right below this low. So, you only got a 5-tick stop, but where's your profit potential? It's back up here to where we were earlier, around 29.99, 3,000. And so what happens? So, this is that low that we were just looking at here, where you have the divergence, you got the ratio. I said, if you weren't convinced, wait till the next bar for confirmation. And you got it. You've got a positive delta, you've got a single print, 2 lots, you got a nice ratio. And what happens? You get a chance, you could buy it, or, anywhere below 29.90. You could buy 29.89, 29.88, 87. And then the market trades right back up to 3,000. So it's given you a nice opportunity. I mean, if anything, you'd probably be a little bit hesitant with these ratios here. You've got a single print here and you got a small print, but this is a little bit stronger than what you're seeing. I'm not necessarily concerned with this single print here because it still has a positive delta, and then the bar behind it, or bar after it's got a positive delta. This one sort of throws a spanner in the work, but you're already in the money. I'm willing to give it the benefit of the doubt to continue up. Okay, so this is a E-mini chart, and I like to trade around the highs and lows. I think that's where it's most interesting, as a trader, to watch what's happening. That's where you're going to see shifts in supply and demand. So we come up here, in the minis. This is a 5-range chart. Earlier I was showing you 10-range charts. Now this is a 5-range chart. 5-range chart is going to move much faster than a 10-range chart, obviously. And what happens? You're seeing some strong buying all the way up. 1,700, 4,000, 3,500. Then you get up here at the high, and it's got a negative delta of 461. You have a divergence. You have a ratio bounds low. You're thinking, why aren't you, you're up here at the high, and all of a sudden you're seeing a lot of negative signs, and then the bar after it, you got a single print, and you get a strong negative delta. So, if you weren't convinced based on what you're seeing in this bar, in the second bar, it's really obvious, especially you got three selling imbalances, you got a strong negative delta, you got a single print. It doesn't get much more cleaner than that. And what happens? The market sells off quite nicely. So ideally you should be looking to get short in this bar. If not, you're short in this bar. In this next bar, you're short around 1920. And then you got a nice, 3 or 4 point move out of it. Okay, this is the E-mini chart again. And this is one I threw this in there because it's one of those things. It's a little bit tricky sometimes if you're sort of in a range. For me, I sort of consider this in a range actually, where you get these point of control sort of lining up. You got this buying imbalance here. I'm looking for it to be support. I don't necessarily like it that we're sort of in this range, and you got this buying imbalance, stack buying imbalance right after you have this ratio here of 0.29. So you got heavy volume here. But what's happened is it's given you a chance to get in here, and it's one of those. It's borderline. This was a trade that I took actually. This was our swing low, and we started coming off of it, and I do know that we stopped up here with this heavy volume, but then we had the buying imbalance here. Like I said, it's a couple points off of our low, but I know I'm staring at this volume here, so I'm a little bit hesitant. But what happened was, I'm looking at this, and where's my stop going to be? Okay, I said, if I'm going to get long, I may run into a bit of resistance here at this level of 90.5. But if I'm getting long in here around 89.5, it's a 5-range chart. I'm looking to get 2 to 3 points. At worst, I'm looking at this low at 87.5 as my stop. I got long somewhere in here. I forgot the exact price. I think it was probably around 89. But then when I saw, this buying imbalance up here, then I was fairly confident because I wanted to see what's going to happen as we're coming back up in there, rather than just sort of go back and forth. When you see this big buying imbalance, 3,000 in the E-minis on a 5-range chart, this is a level for me that's very important. It's something above 2,500. It's telling me, really buyers are being super aggressive and going to take the market higher. And, it did. It popped right up. It's popped right up nicely. I only got 2 points. I figured, I could risk 2 points as my stop down here, and get a 1-to-1 trade. Everyone talks about, you got to have, 4-to-1 reward to risk ratio. It's, if you're going to have a high risk to reward ratio, you're going to have more losers. And what would you rather have, more losers or more consistent winners? Would you rather win 60% of your trades but at 1-to-1, or would you rather win 20% of your trades at 4-to-1? So this was that big buying imbalance that we're seeing earlier here, this 3,323. The market did, spend a little bit of time, before it again popped up, a few more points. I think I got 2 points out of this move. But it's just one of those things, sometimes it does get a little tricky. Everything is not textbook example. I said you got this buying imbalance right off the low, but you have this staring at you in the face. I said I was really looking if we could get past this, this area here where we have the, the point of control sort of acting as resistance. We got past it here, but you got past it, but then you hit a big selling imbalance, and not selling imbalance, big stopping volume. And the market came off a little bit, but then the buyers reappeared. 164.95, 114, even to a lesser extent, this 108. It's not very, very strong, but earlier you had 700. You're not looking at volumes of, 1,300, 300. Even these selling imbalances are 200s. Here you got selling imbalances of 400s. you got to take what the market's giving you. What you saw was the market got stopped here, dropped off, but the buyers came right back in to try and push it higher. We hit this level again. The buyers got super aggressive to get it through this level. That's why the market popped up. So, that's the end of lesson 14. Hopefully by now you should be able to read the market with order flow a bit better. It's not the end all be all. What these charts here? There's charts every day. You can see these things happening. In the next lesson, I'll start to explain the order flow setups that you can look for every day to trade around. Like I said, you could read the order flow as it's happening, but you should have a group of setups. Something to base your what you're going to look for in the market, base your trading around. So thank you. That's the end of lesson 14.